Welcome back to Vantage. We have got a UK equity manager here who's got a great track record of growing income for his holders. He is one of the biggest names in UK investing. Let's go take a look. Welcome back to Vantage. I am delighted to have Simon Gergel from Merchants Trust and Allianz here with us today. Simon, as an introduction, maybe you could just explain your role at Allianz, both in terms of a CIO for the UK business and also a manager of the Merchants Trust.
Yeah, well, hi Neil, great to be here.
Thank you.
Yes, at Allianz, I look after the UK equity team, but I also look after the dividend and value team across Europe. So within my team, we've got people managing income funds, value funds, sometimes what we call dividend funds on the continent.
Yeah.
And for the Merchants Trust, I'm the portfolio manager, so I've been managing merchants for about 17 years now, nearly.
Yeah, I remember you on my very original sort of call list when I started in the city, so that ages us both. Tell us a little bit more about the trust, the size, the number of holdings, what its objectives are, and it's an income trust, so a little bit about the income history.
Yeah, so Merchants Trust has a market value of about 830 million, gross assets, so total investments of 940 million pounds, so quite large. It's in the FTSE 250 index. It's an investment company. The objective is to deliver a high and rising income stream as well as a good total return. So it invests predominantly in large cap UK companies. 95% of the portfolio is in the UK. We've got about 5% in continental Europe. And by investing in the UK companies, we're trying to deliver good returns and a good income stream. And we've grown the dividend every year for 40 years, which has it's been an important objective of the board, is to have a growing dividend each year.
Yeah, okay, interesting. And I mean, given your focus on the UK market, love to get your take in terms of, as we started. I guess last year was a tough year for everyone. I think we're looking into 2023 with a little bit of intrepidation. What's your take in terms of how UK equities are positioned, both from an economics perspective and then how that marries up with how stocks are being valued?
Yeah, well, actually, UK equities had a pretty robust year last year. Resilient, maybe probably a better word. They gave a positive return when most other markets gave a negative return. And it's almost not been noticed that UK equities actually did quite well last year compared to everything else. And I think that could continue. The UK market looks pretty cheap. I think ever since the Brexit referendum in 2016, and we've still got that rumbling on today, there's been reasons for people to not own UK shares because of the uncertainty, political uncertainty, prospects of a changing government at one point, the pandemic, and then the Ukraine conflict. There've been a lot of reasons for people to steer clear of the UK, but actually UK valuations are now very modest. The UK trades at a big discount to the rest of the world. You've got some big international companies with in quite interesting industries. So the UK mix is very different, as you probably know, to other markets. We've got less of the high growth, high technology area where valuations were quite expensive, and that area was under a lot of pressure last year, as you know. We've got more in more traditional industries like mining, banking, consumer goods, which tend to be a bit more resilient in this environment.
Yeah. So
if you combine the valuations of the market with the outlook for most British companies, actually not bad. It's quite good. So we see good value. We see valuations that make a lot of sense for a long-term investor.
Interesting you say that, because we've seen outflows from the UK equities market ever since Brexit. But I've also sort of sensed that, in a high interest rate inflationary environment, actually there's that rotation coming back into value, into old economy names, those cash flowing names. And so I think you're not alone in thinking that the UK market's interesting. Valuation's an interesting point. I mean, maybe we can delve into that a little bit more. And I think one of the things I always like people who've got conviction. Usage of gearing is an interesting signal in terms of conviction. So maybe you can talk about how the UK is faring relative to the rest of the world from a valuation perspective, and actually how you're using, capitalising on that.
Yeah, I mean, it's interesting to expand on that, because I think there have been a number of times in the last 2 or 3 years where people have started to get interested in the UK again, and then you've had problems. So the pandemic was a big one, and the UK suffered quite badly from that. And then coming out of that, I think the whole conflict in Ukraine just put everyone, pushed inflation up and caused people to worry about markets more generally.
Yeah.
And so as you say, there were outflows from pretty much every equity market last year. So yeah, the UK does look interesting. The valuations are very modest, and within the investment trust, within merchants, we can borrow, the board can borrow money to invest long term in the market to enhance returns, and we have gearing, have about 15% gearing. Now what the board did last year, the gearing had come down partly because the markets have been strong, and partly because we've been issuing shares. There have been a lot of buyers of merchants. We've been able to issue new equity. Gearing had come down to about 12%. And the directors decided to take it back up to 15% last November. And at that time, we were saying to them and having discussions and saying, look, actually, the UK equity market, on a long-term basis, is offering really good value. We've got a yield in the portfolio of over 4.5%, and the cost of debt is only around about 4%. So if you don't make any capital return, you've just made the income return, that gearing will still be worth borrowing at 4 and investing more than that. And we think you can make a better return than that over the medium to long term.
Yeah.
So the board were very happy to increase the gearing back up to 15% last November because the market looked good value, and we're starting to get a bit more clarity on what was happening in the economy as well, because I think there'd been quite a bit of uncertainty before that.
Yeah.
It's worth saying long term, our gearing policy is to be between about 10 and 25% at the time we draw down debt.
Okay.
So we're still slightly in the bottom end of that.
Okay. Look, as you're looking to deploy more capital, interesting to understand, what you look for in a company. So maybe you can talk us through effectively the pillars that you look for when investing in a company or a sector, and what gives you conviction.
Yeah, I think there's 3 things we look for in a company, and you can almost think of it in 3 questions. The first question we say is how good a company is this, and we call it the fundamentals. Everything you would expect. Is the industry a good, attractive industry? Has the company got a strong competitive position, decent growth prospects, a strong corporate governance framework, how the board incentivise, how the executives incentivise, what are the environmental, social and governance risks in this business? Put it all together, get a picture of the company, how good a business is it? The second thing we look at clearly is valuations, and we touched on that. We want to buy a company that is good value compared to its history and good value compared to what else we can buy in the market.
Yeah.
We focus particularly on cash flow, but we can look at other measures as well. And the third question we say is, okay, we've got a good business that's cheap, but what's going to change? And we focus on what we call themes, which are what are long-term drivers of this industry, of this sector, of this business. And it could be issues like demographic changes, technology changes. Ideally, we want a company that's got some positive long-term drivers which are going to help the investment case or help the business to thrive. And that's quite a powerful combination. If you've got fundamentally strong business that's cheap with positive long-term drivers, that's very helpful. And in particular, if you're a value investor, the big risk is you buy what's called a value trap, which is a share that looks cheap, but just the intrinsic value is falling every year because there's a structural problem. So what we try to do is try to avoid companies where there's a structural problem that's not really priced into the shares. So by thinking about these long-term themes, that really helps us to try and identify companies which are going to improve over time rather than get worse.
Okay, and I'll come back to that sort of idea of what gives you conviction a little bit later. Mm-hmm. But I think to try and illustrate that sort of approach, I thought we'd talk about the house builder sector, which post I think the mini budget last year, suddenly you saw some extraordinary moves in the sector. Walk us through, how you're looking at it, what you see from a valuation perspective, and from a fundamental perspective, what makes the house building sector attractive.
Well, from a fundamental perspective, the house builders are quite a consolidated industry. Mm-hmm. It's very hard to set up a new volume house builder. The planning rules are incredibly tough. The regulations are tight. Getting land is difficult. But the house builders, and certainly the ones we own, have really strong land banks, have a good record of making high returns, making very good level of profitability, and very strong balance sheets. So they're sitting on net cash. Yeah. They weren't before the financial crisis. They all had debt, but now they've learned a lesson, and they're sitting on net cash and a strong balance sheet, strong land bank. So they're fundamentally very robust. Valuations are modest. They're trading at a big discount to the value of their assets, which is really land, which they can turn into houses, which is quite unusual. Yeah. And on other measures, on earnings basis or dividend measures, they look attractive too. And then in terms of long-term themes, this is where it's really interesting. We've got a shortage of housing in the UK. We know that there's demand, strong demand long-term for housing, so that gives them growth opportunities. And as I say, it's quite a consolidated industry, so there's that means the dynamics probably remain quite favourable for the house builders. Limited supply, strong demand is helpful long term. So put all that together, you've got strong businesses, low valuations, and hopefully a supportive thematic environment.
Yeah, interesting. I mean, I think it's a sector where there was so much fear at the time, but actually it looks overdone, and I think there's a real opportunity there.
I mean, there's no doubt it's a cyclical industry.
Yeah.
So if volumes fall, and they are falling in terms of new house transactions, and if prices fall, and they may well come down a bit, the profits of the companies could come down a lot in the short term, but over time they reset the business because they buy land cheaper, they can make a margin on the cost of building the home.
Yeah.
But all the component costs come down as well. So the cost of labour, the cost of materials, they all follow house prices down as well. So what you find over time is, although the business is cyclical, the profits recover quite quickly once the business resets.
So you mentioned some themes and investing in themes. I'm curious if you can talk me through, maybe looking back at the last 6 to 12 months, some of the new entrants into the portfolio, the themes driving that, and what gave you conviction around that.
Yeah. I would say about a year ago we were finding opportunities across the market in both the more defensive areas, companies like Unilever, food, consumer products companies, or Haleon, which spun out of GSK, which has products like Sensodyne toothpaste and vitamins and Panadol, painkillers. Those defensive areas, but also more cyclical areas, companies like building companies like CRH and so on.
Yeah.
As the year's gone on, the defensive shares generally perform better, as you might imagine, when people were worried about the economy.
Yeah.
But the cyclical shares got much cheaper, so we found some good opportunities in more cyclical areas. One of the most recent shares we've added is a company called Pets at Home, which runs obviously a large number of pet stores in the UK, pet food and this stuff. But actually the secret, or I think the interesting part of the business is the vet business they've got, Vets for Pets. Yeah. Where a number of those stores have vet practices in them, and they have a joint venture model with the vets. Yeah. And what you saw is, along with many other retailers, the shares got quite depressed in the second half of last year. The valuation came down to an interesting area. And we think it's a very strong business underlying, and that the vet business has got good structural growth as people spend more money on their pets and want them to. It's called a humanisation trend, believe it or not, which is people are buying gifts for their pets and dressing them up, and also giving them much better health treatment and much better quality food, which over time is growing the business. So we see quite a lot of growth in that company, and we saw an attractive valuation.
Okay, interesting. I'd like to. So you talked us through things that give you conviction. One of the things that I noted in terms of when you talked about what detracted from the portfolio last year was not only Astra, which has done extraordinarily well over the last 2 or 3 years, and I thought it might be a good way of trying to understand actually what stopped you having conviction. So when you looked at the stock, what was it that sort of persuaded you not to go into it?
Well, I think almost need to turn the question around and just explain. We try to buy companies where we have a positive view on a stock. If we don't have a positive view on a company, we don't want to own it in the portfolio. Yeah. It doesn't mean we're negative. So it's not like there's some issue with Astra that meant we didn't want to own it. It's just we didn't have a positive investment case. It was a combination of the valuation not being compelling, and some of the accounting policies and the cash flow. Cash flow has not been great over a number of years, but so there wasn't enough there for us to get conviction in it. And we like GSK, GlaxoSmithKline. Yeah. We like Sanofi, which is a European pharmaceutical company. So we've got exposure to that industry where there are some attractive trends, and we didn't have a positive investment case on Astra. So that's the way we approach it, really. And we only want to have companies in the portfolio where we've got conviction.
Okay. One of the things I think I wanted to ask you about is that I think that pandemic period is something where we all learn something, and particularly when you're running an income portfolio. What are the sort of main learnings in terms of you saw these companies suddenly under a lot of pressure, having to cut dividends, How'd you guide yourself through that? And the reason I ask you is that knowledge and wisdom is something I want to explore a little bit.
I think what you've always got to do, and actually we've had a number of instances in the last 7 or 8 years where we've had big events that we didn't necessarily expect, like the Brexit referendum result, the pandemic, the Ukraine invasion. You have to take a step back and say, how does this really impact the long-term value of businesses? So there's a lot of volatility, a lot of uncertainty in the short term, but is this business fundamentally strong? Will it recover? Is it financially strong enough to get through this period? And if you can tick the box and say, yes, it's financially fine, it's got a really strong business model that will recover over time, then you can take a 3 to 5 year view and say, I believe in this company on a medium to long-term view. I can't necessarily predict what's going to happen for the next 6 to 12 months. And quite frankly, in the middle of the pandemic, nobody knew what was going to happen. But you could say, I believe in these businesses and I'm going to stick with them. And there are others that actually say, well, they could be compromised. Things have changed. Working from home might be different from working in the office. So there are open questions at that point. You just have to be very open with what's your investment case on a stock? Has it changed? If the share price has moved a long way, is that an opportunity to buy more if it's gone down a lot? Or is it telling you something new? And you just have to be really objective as an investor and say, and be humble and say, I don't know, let's investigate that. And in some cases we came out with strong conviction. In others we sold shares. And in third cases we said, we don't really know. Let's just observe this, watch it for a while and work it out.
Okay. And look, a lot of our viewers, a large part of our viewership actually, watch these for their own education, learning how to invest, etc. And it's why we like to talk to professionals. As CIO of the sort of UK business, I'm sure you meet many new starters within the business. So I guess I asked that question really as the final sort of question I want to ask you is given your length of experience of investing in the market, what are the kind of things that you're trying to impart on a new person embarking at Allianz?
Well, you want people to have enthusiasm, interest, and passion really for what they're doing. But I think an element of humility is really important. I mean, as fund manager, you're never going to know more about a company than the people running it, or you're never going to be an expert on every business. You have to realise there's things you don't know, things you can't know about companies, and you have to take decisions based on the best information you've got and a view. But be prepared to change your mind because new things happen. You can get things wrong, and you have to be aware of that. And situations change, so you just have to be constantly reassessing with an open mind. I used to say you want to be open-minded, but not so open-minded your brain falls out. You have to get the balance right between always reassessing things, but being prepared to have conviction and stick with a view. If you're convinced it's right and you've done the homework and you've checked it, then you've got to be willing to stick through it, even if the share price might be going the other way, because you've got to have a strong enough.
And I guess the way you approach things is that you're looking for high quality businesses which should stand the test of time. So I guess inevitably you're going to be patient and not change your mind very much, but once in a while things will change.
Absolutely, and the pandemic was a good example of a time when you've absolutely got to rethink things you know about certain industries. Excellent.
Simon, thank you so much for coming back onto Vantage. It's been a pleasure having you here, and we're looking forward to seeing how the year pans out with you.
It's been a great pleasure. Thank you.
Thank you.